In this week's market update, shares continue to fall despite drastic action from the Fed. Interest rates at all-time lows put the onus on governments to intervene with fiscal stimulus, and safe havens fail to provide a port in the storm. Stock markets continued to dive yesterday despite a dramatic intervention by the Federal Reserve on Sunday evening, when it cut interest rates by a full percentage point to just above zero and initiated a $700 billion quantitative easing program. Wall Street once again triggered a temporary shutdown of trading soon after the open yesterday, but fell further once dealing resumed, finally closing 12% lower in the worst day for US stocks for more than 30 years. Nasdaq had its worst ever day, down 12.3%. That reversed the 9% gain with which US shares closed last week, a day after they'd fallen by a tenth on Thursday. The past few days have therefore seen the most volatile market conditions since the financial crisis in 2008-9. On this side of the Atlantic, the FTSE 100 fell by 4%, with even bigger falls in continental Europe. Both France and Germany's markets were down by a tenth at one point, as was the Europe-wide Stoxx 600 index, although it too recovered to close 5% lower. The UK's blue chip index is now a third lower than its peak in January this year. It's not just the scale of the falls that shocked investors, but the speed of the decline, as markets have quickly priced in a worst-case scenario of recession in many countries around the world. Just a couple of months ago, the prevailing view was that coronavirus was a largely Chinese affair that would not materially impact the global economy. That view looks ridiculous today. There was partial relief on Tuesday as stocks in Asia recovered some ground. Markets opened higher in Europe too, and expectation of Congress approving a bill to help the US deal with the fallout of the pandemic supported futures in New York. The unprecedented nature of the rout was, however, illustrated by the Philippines announcing that its stock, bond and currency markets would shut until further notice. Attention has focused on the stocks most at risk from the effective lockdown of whole countries, which has pushed aviation businesses in particular close to collapse. British Airways owner IAG fell by 25% on Monday, with Air France KLM 18% down and Lufthansa 11% lower. Airlines have warned a prolonged shutdown in travel and tourism would put their survival at stake. Also under severe pressure are banks, with the S&P 500 bank index falling 17% yesterday, its worst performance since the 2008 credit crunch. Banks are under attack on several fronts, including their exposure to the indebted energy sector, which has been hit by a dramatic decline in the oil price over the past week. The market's reaction this week is exactly what the Federal Reserve was hoping to forestall with its dramatic and unexpected move on Sunday evening to slash interest rates back to their all-time low and to restart massive purchases of Treasury bonds and mortgage-backed securities. By cutting rates all the way back to close to zero, the Fed has effectively made a last throw of the dice for monetary policy. The onus is now on governments to step up to the plate with fiscal stimulus, increasing public sector spending to boost the global economy now that central banks have used their last shots. No one is yet clear whether governments have the willingness or the ability to engage in the kind of coordinated action that central banks have sustained over the 12 years since the financial crisis. It now looks likely that the economic downturn will be as deep as that caused by the global financial crisis. Chinese GDP may have fallen by as much as 13% in the first 2 months of the year. That means that governments will need to allow deficits to rise sharply, as they did in 2008-9. Between 2008 and 2010, public debt in G7 countries rose by between 10 and 25% of GDP. While the Fed's actions may prove to be insufficient, they're widely seen as necessary, significantly easing stresses in funding markets where commercial banks dip into the massive pools of liquidity that only central banks can supply. Without this massive easing, many feared for a repeat of the credit crunch which triggered the savage recession of a decade ago. Market volatility is being exacerbated by a constant stream of negative headlines on the coronavirus outbreak. On Monday, a leaked document from Public Health England warned that almost 8 million Britons may need to be hospitalised in a reasonable worst-case scenario. Meanwhile, figures released the same day showed that China suffered a record blow from February's economic standstill as the country battled to contain the outbreak. Industrial output fell by 13.5% in the first 2 months of the year, urban unemployment rose sharply, and retail sales fell by more than 20%. In Europe, now the epicenter of the outbreak, countries including Germany are moving to close their borders and closing shops other than those selling food and drink. Manufacturers, including Rolls-Royce, Ford and Honda, have been asked to help with the production of medical equipment, of which there's a severe shortage. More people have now been infected outside than inside China. In America too, cities are ordering bars, restaurants and other public venues to close. The most extreme measures have been taken in France and Northern California, where Italian-style bans on anyone leaving their homes have been enforced in a bid to halt the spread of COVID-19. France on Tuesday announced a 45 billion euro set of measures to support the economy, including payments to temporarily unemployed workers and deferral of taxes. In other markets, the price of Brent crude fell below $30 a barrel as investors shrugged off the Fed's action and focused instead on the actual and forecast decline in demand for oil. Brent fell more than $4 or 12% to $29.80, with US WTI crude down almost as much. The oil price has collapsed since talks between Saudi Arabia and Russia, designed to support the oil price, broke up in acrimony 10 days ago. Unable to present a united front, the two oil producers have adopted a beggar thy neighbour approach, with Russia aiming to fatally wound US shale producers and Saudi Arabia determined to compensate for a lower price with massively higher volumes. The falling oil price is actually one of the only bright spots in the otherwise bleak economic outlook, as it reduces the cost of a key input for both industrial businesses and individuals via lower petrol and heating bills. In recent years, however, the US economy has shifted from being a major oil importer to being one of the world's largest producers of oil. Parts of the US economy now suffer from lower prices, even as others benefit. Another market which has defied some more optimistic expectations is gold. The precious metal is typically viewed as a hedge against uncertainty, rising in price during crises as investors seek a port in the storm. This time, however, cash-strapped investors have looked to take profits where they can to offset losses on their equity portfolios, and the gold price has actually fallen by more than $150 an ounce to today's price of about $1,500. In currencies, however, investors have gravitated towards safe havens, with sterling falling sharply against the dollar. Over the past week, the pound has dropped from $1.31 to $1.22. The dollar has also risen against all currencies in recent days, including the yen, but gave up some gains after the unexpectedly large cut in US rates. And finally, in other non-market news, although not un-corona related, Georgia followed Louisiana's lead in delaying its presidential primary election. The move came just a day after Florida, Ohio, Illinois and Arizona said they would go ahead with theirs, despite fears over the dangers of large gatherings of people as the electoral jamboree rolls through the states. Both Joe Biden and Bernie Sanders have significantly scaled back their campaigning, cancelling rallies and telling staff to work from home.